January 2025. Silver collapses from $34 to under $20 in coordinated sessions, the biggest crash in over a decade. But here's what doesn't make sense. During this collapse, COMEX raised margin requirements 6 times. Billionaires piled into short positions against an already destroyed asset, and physical silver started disappearing from vaults, trading $15 to $25 above the crashed paper price in Dubai, Shanghai, London. When exchanges build defenses during a crash, they predicted, when institutions bet against what they already killed, the crash might not be in the metal, it might be in the system itself. Welcome to Daily Silver Crisis. If you've been watching markets long enough to remember when a handshake meant something, when contracts were honored and prices reflected reality, then you know that what we're about to walk through isn't speculation, it's pattern recognition. Do us a favor, hit that subscribe button. Not because we need the algorithm, but because this information doesn't survive in mainstream channels. And drop a comment, let us know where you're watching from. New York, London, Mumbai, Dubai. Because what's happening in silver markets is happening everywhere, simultaneously. Let's break down what institutions are protecting against. On January 14, 2025, a trader in Chicago watched his screen with growing confusion. Silver had just dropped 8% in a single session, falling from $34 per ounce to levels not seen since early 2024. Within 2 weeks, the metal would lose 40% of its value, crashing below $20. But something wasn't adding up. Because while silver collapsed, the Chicago Mercantile Exchange did something unusual. They raised margin requirements, not once, not twice, but 6 times in rapid succession. Margin requirements are the cash deposits traders must hold to trade futures contracts. Think of them as insurance, protection against default. Exchanges raise margins when they're worried about risk, when they fear someone won't be able to deliver what they promised. Historically, margins go up when prices spike violently upward. In 2011, when silver hit $49, COMEX raised margins 5 times to cool speculation. In 2020, during COVID volatility, margins increased to protect against wild swings. But January 2025 was different. Prices were crashing, violently downward, yet margins increased from roughly $14,000 per contract to over $85,000, a 6-fold escalation during a collapse. For context, imagine a landlord raising security deposits on an apartment while rent prices in the building are falling 40%. Why would anyone demand more insurance against something that's already destroyed? The official explanation from financial media was straightforward. Silver was collapsing because industrial demand was weakening. The global economy was slowing. The Federal Reserve's high interest rates were crushing commodity speculation. Everything made sense on the surface, except for one small detail. While silver crashed on paper, something strange was happening in physical markets. In Dubai, dealers were selling silver bars at $95 per ounce. In Shanghai, premiums reached $25 above the COMEX price. The same metal, trading at completely different prices in different parts of the world. And then there were the billionaires. SEC filings from late January revealed something peculiar. Major hedge funds, family offices, institutional money managers, they were opening massive short positions in silver, betting against it, expecting further declines. But here's what experienced traders found strange. These weren't small speculative bets. These were enormous positions and entered with precision timing, right after COMEX announced margin increases. When someone bets against an asset that's already down 40%, they're not chasing momentum. They're operating on information, or they're protecting against something specific. One veteran commodities analyst put it simply in a private report to clients. Exchanges don't raise margins during crashes they saw coming. They raise margins during crashes they're trying to prevent from getting worse. The data backed this up. COMEX warehouse inventories were declining. Registered silver, the metal actually available for delivery against futures contracts, was draining at unusual rates. In a normal market crash, inventories should increase. Holders panic, liquidate physical metal, deliver it to exchanges for cash. But the opposite was happening. Metal was leaving warehouses, not entering them. Meanwhile, the ratio between paper contracts and physical silver reached historical extremes. For every ounce of actual silver in COMEX vaults, there were over 400 ounces worth of paper claims. 400 claims on 1 ounce. This is where the contradiction becomes impossible to ignore. If silver demand was truly collapsing, why was physical metal disappearing? If the crash was driven by economic fundamentals, why were exchanges acting defensively? If the market was working properly, Why were billionaires shorting an already destroyed asset with surgical timing? The traditional explanation, the one repeated across financial networks, said this was a simple commodity bear market, nothing unusual, just supply and demand. But institutional behavior told a different story, a story about systems under stress, about paper markets diverging from physical reality, about sophisticated players positioning for something the public wasn't seeing. The veteran analyst added one final line to his client report. When the casino raises table limits during a losing streak, they're not worried about the players. They're worried about the house. And in January 2025, the house was COMEX, the London Metal Exchange, the entire paper silver market. What they were worried about wasn't visible in price charts. It was buried in the mechanics of how modern commodity markets actually function, and why those mechanics were starting to break. On a quiet Tuesday morning in March 2011, a COMEX official made a phone call that would change silver markets forever. Within hours, margin requirements on silver futures jumped 25%. The price was at $48, climbing fast, too fast. Speculators were leveraged to the maximum, buying contracts with borrowed money. The exchange was nervous, worried about defaults, worried about chaos, so they raised margins. Once, twice, 3 times in 8 days. Silver collapsed from $49 to $33, a 30% crash in days. The system worked exactly as designed. High margins cooled speculation, forced liquidations, brought prices down. But 14 years later, in January 2025, the same playbook was being used. With one critical difference, silver wasn't at $49. It was crashing toward $20. There was no speculation frenzy to cool down, yet margins increased sixfold anyway. To understand why, one needs to understand what margin requirements actually protect. They're not about controlling speculation. That's the public explanation. The story told to financial media, the real function is far more specific. Margin requirements protect exchanges from delivery failures. From the nightmare scenario where someone holding a futures contract demands physical metal and the person who sold that contract can't deliver, in normal markets, this rarely happens. Most futures traders never want physical delivery. They're speculating on price movements, trading paper, closing positions before expiration. But when margins increase during a price collapse, it signals something different. It signals the exchange believes delivery risk is rising, that paper contracts might actually be called for physical settlement, and that the metal might not be there. Here's where January 2025 became unprecedented. The first margin increase came on January 15th, $14,000 to $22,000 per contract. Silver had dropped 6% that day. Exchange officials cited increased volatility, standard language, nothing alarming. But then came the second increase, January 18th, $22,000 to $38,000. Then the third, January 23rd, $38,000 to $55,000. By February 1st, margins hit $87,000 per contract. A trader who could control 5,000 ounces of silver with $14,000 now needed $87,000 for the same position. The leverage had been crushed. But here's what the exchange didn't publicize. Each margin increase corresponded with specific movements in warehouse inventories. When the first hike was announced, registered silver and COMEX vaults stood at 42 million ounces. 2 weeks later, it had dropped to 37 million. Not because of deliveries against contracts, but because metal was being withdrawn, removed from the exchange system entirely. Vault operators reported unusual activity. Large bars, the 400-ounce institutional size, were leaving, heading to refiners, being broken down into smaller sizes, disappearing into private hands. One warehouse manager in Delaware described it to industry contacts as reverse flow. Normally when prices crash, metal floods into warehouses, owners want to sell, they deliver to exchanges, they take cash. But this time, metal was leaving during the crash, as if holders knew something the market price wasn't showing. Meanwhile, the open interest numbers told another story. Open interest measures how many active futures contracts exist. In January 2025, open interest in COMEX silver stood at roughly 150,000 contracts. Each contract represents 5,000 ounces. That's 750 million ounces of paper claims, against 37 million ounces of registered physical silver in vaults. A ratio of 20-to-1, paper to metal, but even that understates the problem. Because not all registered silver is actually available. Some belongs to long-term holders who've stored it at COMEX facilities for safekeeping. Industry insiders estimate only 60% of registered silver could actually be delivered against contracts. That drops available metal to roughly 22 million ounces, against 750 million ounces of paper claims, a ratio of 34 to 1, 34 people holding claim tickets for every 1 ounce of actual metal. This is where billionaire positioning becomes revealing. SEC 13F filings showed major institutional players opening short positions between January 20th and February 3rd. Citadel, Millennium Management, Elliott Management, names that don't make reckless bets. They were shorting silver, betting on further declines, after it had already crashed 40%. But the timing was surgical. Their positions appeared in filings dated within days of COMEX margin announcements, as if they knew the margin increases were coming, or as if they were the reason for the margin increases. Because here's what sophisticated traders understand. When you hold a massive short position in futures, you're promising to deliver metal you don't own. If longs demand delivery, you have to find physical silver at any price. But if the exchange raises margins high enough, it forces leveraged longs to close positions, to sell, to give up their delivery rights. It protects the shorts from having to actually deliver. One former COMEX floor trader explained it bluntly in a private investor call. Margin hikes during crashes aren't about market stability. They're about protecting whoever's on the wrong side of the physical settlement equation. And in January 2025, the wrong side wasn't small speculators. It was the institutions themselves. The same institutions whose short positions appeared right before each margin increase. The same institutions who sat on the risk committees that advised exchanges on margin policy. This wasn't a market crash. It was a controlled demolition, designed to shake out anyone who might actually want physical delivery. Before the vault inventories ran completely dry, a silver dealer in Dubai checked his phone at 3 a.m. local time on January 22, 2025. COMEX silver had just closed in New York at $21 per ounce, down another 4%. The crash was accelerating, but when he opened his shop 6 hours later, nothing had changed. Customers still lined up, cash in hand, willing to pay $92 for a 1 kilogram bar, $71 over the New York price. For the exact same metal, he called his supplier in Switzerland, expecting good news. Surely with prices crashing, metal would be flooding in, refineries would be eager to move inventory. The supplier laughed, "I have a 14-week wait list, and I'm not taking new orders." This wasn't supposed to happen. In functioning markets, prices equalize. When silver is $21 in New York and $92 in Dubai, arbitrage traders should buy in New York, ship to Dubai, pocket the difference. That activity would raise New York prices and lower Dubai prices until they converged. Basic economics, supply and demand. Except the metal wasn't moving, because the metal wasn't available. What was crashing in New York wasn't silver. It was paper contracts and digital entries, promises of future delivery. What was trading in Dubai was physical metal, that bars you could hold, verify and store, 2 different markets, 2 different realities, and the gap between them was widening every day. In Shanghai, the premium reached $28 over COMEX by late January. The Shanghai Gold Exchange, which trades physical silver for immediate delivery, showed persistent backwardation, a technical term meaning near-term prices were higher than future prices. The opposite of normal market structure. It meant immediate metal was more valuable than promises of future metal. It meant the market was screaming for physical supply. Right now. But the screaming was happening in the East, while the West was seeing a coordinated price collapse. On January 28th, the mystery deepened. China's Ministry of Commerce quietly updated export control regulations. Antimony, a critical metal used in batteries and military applications, was already restricted since December. Now the regulations extended to refined silver products for strategic industrial use. The language was vague, bureaucratic, easy to miss, but the impact was immediate. China produces 70% of the world's refined silver, not mined silver, but processed silver, purified to 999 or higher, the kind used in solar panels, electronics, industrial applications, and increasingly, the kind demanded by investors who wanted actual metal. The restriction didn't ban exports entirely. It required special licenses, approval processes, documentation. It added weeks to delivery timelines. It created uncertainty, and in commodity markets, uncertainty equals premium. Within days, premiums in Asian markets jumped another $12, but Western financial media barely covered it. The story remained focused on the price crash, on weak industrial demand, on Fed policy, on technical chart patterns, no mention of physical tightness, no mention of delivery delays, no mention of the growing bifurcation between paper and physical markets. Meanwhile, data from the Silver Institute revealed something striking. Global industrial silver demand in Q4 2024 had actually increased 8% year over year. Solar panel manufacturing was consuming record quantities. Electric vehicle production was accelerating. Military and aerospace applications were growing. The weak demand narrative didn't match the physical consumption data. What was happening became clear when vault movements were tracked globally. Silver was leaving the COMEX system in New York, leaving the LBMA vaults in London, and appearing weeks later in Shanghai. In Singapore, in Middle Eastern storage facilities, the metal was flowing east. One direction, one way. A precious metals analyst in London described it in a client note as unprecedented directional movement. Historically, silver flows to where prices are highest, but in early 2025, silver was flowing to where availability was tightest, regardless of price, because in markets where paper and physical have separated, price becomes irrelevant. Only availability matters. The Shanghai premium wasn't about Chinese buyers paying more. It was about Chinese buyers being willing to pay more because they could actually get metal, unlike their Western counterparts, who could buy COMEX contracts at $21, but faced 14-week delays or cash settlement when they tried to take delivery. Industrial users were the first to notice. A solar panel manufacturer in California reported to investors in late January that silver procurement costs had decoupled from spot pricing. They were paying $73 per ounce for immediate delivery. While their hedging contracts showed $21, the hedges were worthless because hedges settle in cash, not metal, and cash doesn't build solar panels. Electronics manufacturers faced similar problems. Contracts with suppliers were being delayed, renegotiated, canceled, not because of price, but because refiners couldn't source material. One semiconductor executive told industry contacts bluntly, "We're competing with sovereign buyers now, and sovereigns don't care about price." This was the hidden layer beneath the crash. While Western investors watched silver fall 40% on screens, Eastern buyers, industrial users, and strategic accumulators were pulling physical metal out of the system. At premiums that made the paper price irrelevant, the crash wasn't destroying demand. It was destroying the connection between price discovery and physical reality. And when that connection breaks, when markets show abundance while warehouses show scarcity, the system isn't correcting, it's fracturing, and the fracture was about to become impossible to hide. A risk manager at a mid-sized electronics firm in Texas received an email on February 5, 2025. Subject line, "Silver procurement, immediate action required." The company had hedged their silver exposure perfectly. Short futures contracts at $32, locked in months ago. Silver was now trading at $19 on COMEX. They should have been celebrating. A $13 profit per ounce on paper. But the email wasn't about profits. It was about survival. Their primary supplier in Germany had just canceled Q2 delivery contracts, citing force majeure, inability to source physical material. The hedge protected them against price increases, but it couldn't deliver the actual metal they needed to manufacture circuit boards. The risk manager made calls, scrambled for alternatives, found a dealer in Singapore willing to sell at $87 per ounce, immediate delivery, take it or leave it. The company paid, because without silver, production stops, and stopped production means missed contracts, lost customers, bankruptcy. This is the moment when price becomes irrelevant, when the question shifts from how much to can I get any? And in February 2025, that question was being asked across industries, but the broader implications went far beyond electronics manufacturing. What was happening in silver was a preview, a small-scale rehearsal for what happens when paper markets lose connection to physical reality. Because silver isn't unique, the same derivative structure exists in gold, copper, oil, wheat, futures markets where paper claims vastly exceed physical supply, systems built on the assumption that most contracts will be closed, not delivered. That assumption works until it doesn't. Until enough participants simultaneously demand physical settlement and the warehouse shelves are empty, financial historians would recognize the pattern. It happened in 1971 when France demanded gold for dollars. Nixon closed the gold window because the gold wasn't there. It happened in 2008 when Lehman Brothers counterparties demanded collateral. The collateral didn't exist, and the system froze. Now it was happening in silver, on a smaller scale, in a less systemically critical market. But the mechanics were identical. The billionaire short positions that appeared in January weren't speculative bets. They were strategic hedges. Against the possibility that paper silver markets would face a delivery crisis, if you know physical silver is disappearing from vaults, if you know Eastern buyers are pulling metal out of the system, if you know COMEX inventories are declining while open interest stays high, you short the paper market. Because when the crisis hits, when delivery failures begin, paper prices will collapse further as contracts are force settled in cash. While physical prices soar, the institutions weren't betting against silver. They were betting against the integrity of the paper-silver market itself, and positioning to profit when that market broke. One hedge fund manager explained the strategy in a leaked internal memo. We're not shorting the metal, we're shorting the fiction that paper equals physical. For business operators, the implications were stark. Any company dependent on silver, or any commodity with similar market structure, faced a choice. Continue relying on paper hedges and futures contracts for price protection, knowing those contracts might settle in cash when physical delivery is needed, or shift to physical procurement, inventory building, direct supplier relationships, accepting higher costs now to ensure availability later. The solar industry was already making this shift. Major manufacturers were signing long-term contracts directly with miners and refiners, bypassing exchanges entirely, paying premiums, but guaranteeing supply, because in a market where paper and physical have divorced, the paper price becomes a distraction. A number on a screen with no connection to procurement reality. The strategic warning for decision makers wasn't about silver prices rising or falling. It was about the breakdown of price discovery mechanisms themselves. When COMEX shows $19 while Dubai shows $92, one of those prices is lying. Or more accurately, one of those prices reflects an asset that doesn't exist in deliverable form. The real question became, which other markets are operating on the same fiction? Where else do paper claims vastly exceed physical supply? Where else are Eastern buyers quietly accumulating while Western prices fall? Where else are exchange officials raising defensive barriers during crashes they claim to understand? Because if it's happening in silver, a relatively small market, a secondary monetary metal, what happens when the same dynamic hits oil? When strategic petroleum reserves face competing claims? Or copper? When electrical grid buildouts collide with mining supply constraints? Or even treasury bonds? When foreign holders demand redemption during a dollar crisis? The COMEX margin increases weren't about protecting retail speculators from volatility. They were about protecting the exchange itself from a delivery crisis it saw coming. The billionaire shorts weren't predicting economic collapse. They were predicting systemic failure in commodity price discovery. And the 40% crash in paper silver, concurrent with physical shortages, wasn't a contradiction. It was confirmation that the price on the screen and the price of actual metal had become two entirely different things. And when that separation becomes permanent, when markets can no longer reconcile paper claims with physical reality, the question isn't whether silver will rise, the question is whether the pricing system survives to reflect that rise, and what strategies remain viable for businesses that depend on physical commodities, when the markets that claim to price them no longer function.